Well, Mr. Fred, what's going on in the world of money? That's your specialty. How's business? People what's it like selling gold and silver coins these days? Brisk, medium, rare?
It's been incredible.
Really?
The numbers are staggering. The volume of people, the new investors coming in. Interestingly, a lot of young people are beginning to learn about this industry by virtue of things like YouTube and Facebook and Twitter and things like that didn't, really, for all intents and purposes, even exist 10 or 15 years ago. So information is spreading in a new fashion. So, when you and I grow up, and I put us in roughly the same bracket, I mean, our information came from the news.
Walter Cronkite, right? David Brinkley.
Printed newspaper.
Oh, yeah.
Well, a little before my time, but so, we had the newspapers and we had TV news, and that's where we got all of our information from. Other than that, we had this old style of learning. It was called reading books. And I know it's a strange thing. People don't even know what those things are anymore. But yeah, we had to actually pick up physical books and read words on pages.
My God.
And, that's how we absorb information. But the modern era, for whatever it is, one of the advents has been this ability to let information flow through a whole bunch of new media outlets. And amazingly, I'm finding like a whole new generation of younger Americans who are growing in their concern and awareness of what's going on in the world of economics and money and taking positions in gold and silver, that.
Oh, that's great.
I think it's fascinating.
That's great.
So we've actually found business has been rather good.
Well, I think about it when I get, you always go back and think about, because remember Andrew used to talk about saving, 10% or something, just socking away. Of course, nobody does it, but hey, could you imagine, when you're 16 or 18 and you really understood silver and gold and you buy a little bit every month, just a little bit, and what you'd have like when you're 60 or 70, oh my God, it'd be, out of control, right? Yeah.
Yep.
Yeah.
I mean, I remember when I first started in my early 20s, and I wasn't making a lot of money, so if I had 50 or $40 or whatever.
Whoops! Wait a minute. I lost you on your mic. Hold on a second. Somehow I know what I did. Hold on, Fred. Let me put you over there, and then I can fix your mic. Go ahead. So you were talking about when you were 20. Go ahead.
Yeah, I mean, I barely had enough money to pay my bills, but if I had an extra 40 or $50, I bought a few little silver dollars or silver quarters or dimes, whatever I could get. Within about 10 years or so, I ended up with this shoebox. And, it was full of stuff. And at one point when I had, financial problems in my early 20s, and, I had ended up saving a few $1,000s worth of silver. And it was amazing because I had never been able to put that much at one time away, but just by simply chipping away at it, every week, every time I could, it builds up. So it's important because unfortunately we're at a point now in America where, when people think about their savings, it's critical to understand what form are you saving. Are you saving paper money in the form of Federal Reserve notes, things that are tied to the value of a paper dollar, or are you saving, what we would refer to as real money? And unfortunately, I have a fundamental problem with the idea of trying to preserve wealth in the form of saving capital with paper notes, because the value of paper money is definitely being altered by forces outside of the hands of the average American. So we're sort of subject to the result without having any influence on the reasons why the money is losing value.
Right. I was looking at the Federal Reserve's balance sheet, and so the Federal Reserve Bank, folks, is a private bank. They're owned by private banks, and they have a balance sheet, and they buy, and I'm going to ask Fred about reverse repos. We want to learn about those today. You know about those? Because I see this a lot, and I want to understand what those are about. But anyway, it's over $8 trillion, these bad boys up there in the Federal Reserve Bank of New York. Over $8 trillion on their balance sheet. And so tell folks what that means. What they're doing is they create dollars, right, on a computer, and they buy stuff. Well,
basically, all right, so fundamentally, when Congress engages in deficit spending, So in other words, Congress spends more money than it brings in.
I'm
It
shocked.
has to make up the difference, and it does that by issuing debt. And the debt has to be then purchased by somebody. And as it turns out, the Federal Reserve has stepped in and it has infiltrated the economy in a massive, massive degree to purchase a lot of the debt from the United States government to allow the government to continue this deficit spending problem. It was intended that the Federal Reserve be such a powerful force in the economy. And to put it in perspective, what we were looking at in just a few years has been an enormous change in terms of the amount. For example, just as a statistic, excess bank reserves held in deposit accounts at the Fed grew from less than 2 billion, 2 billion.
Uh-huh.
This was in August of 2008 to more than 3.8 trillion right now.
Okay, let's stop
In the
and
same
tell
period
folks
of
what that
time-
means. Hold on. So they had 2 billion
Yep.
of their excess dollars that they say they send it to New York Fed, and they get whatever interest on that, right? A little bit of interest, a
Right.
quarter point
Excess
or whatever.
bank reserves.
Excess bank reserves. So in 2008, Lehman, the day Lehman died, they had 2 billion, and now they have 3 trillion.
3.8 trillion.
Whoa, that's like 4 trillion. That's like almost $4 trillion more than they had 12 years ago, or 20, 12, 13.
Oh, and when they started with that, also, if you think about what they've also done with Treasury securities, there was 500 billion on the Fed's balance sheets in Treasury securities in 2008,
500
half a
billion.
trillion. Now there's 5 trillion
Yes,
just in Treasury.
just in treasuries, yeah. So
Right.
these excess
they've also been
reserves, it's so much money that the banks have who own the Fed. Why do they put it at the Fed, and why does it even? What does it tell us about the state of the world and the dollar and everything? What's going on?
Well, it's getting a little bit convoluted. The problem is the Fed is trying to manipulate the economy. So traditionally, they do that simply by raising or lowering the standard interest rates. The thing that most people would understand.
Credit cards.
What are you paying up or down on a mortgage? How much interest are you getting paid on a CD? And this was the standard method the Fed used to intervene in the economy.
Mm-hmm.
And it was more like, I guess the analogy would be like if you're riding in a boat, doing that was like the equivalent of altering the rudder. You could shift, you could change the direction a little bit. You could account for variations in the water and the waves and things. So you made minor adjustments through the rudder.
Mm-hmm.
The Fed has now moved from, merely adjusting the rudder. They've taken over the engine, and they're now driving the boat. They have become so much of a force in the economy that they're no longer making minor adjustments to a broader picture of economic environments. They are controlling the economy. They are the force behind what's driving the economy, which is becoming progressively more and more dangerous because the Fed is now in a position where if it makes a misstep, it is going to have a much larger impact on the broader economy than if it were merely making minor adjustments. So as the Fed tried to intervene in the economy, it continued to lower interest rates. The thought process was this cheaper money would drive the economy forward. And as we were coming out of the Great Recession of the late George Bush era, and we moved forward, the first job the Fed took on upon itself was to try to move the economy forward by lowering rates and lowering rates. Well, eventually they got to the point where, you could only go so far down. When you hit zero, you're pretty much left at a kind of a difficult point there. There's nothing left to do.
Right.
And with the advent of almost zero interest rates for a long period of time, it wasn't sufficient to move the economy forward. So the Fed found it necessary to start using other means to alter the environment. So it began to encourage banks to carry excess reserves, which effectively has the same result of lowering interest rates. If they can drive rates down and keep rates cheap, again, they can help stimulate the economy. So the Fed began to encourage excess reserves from banks by paying them a higher yield. The Fed began to buy treasuries from the
Okay,
U.S. government.
let's stop there a little
not
bit.
only-
Let's stop there a little bit so people
Sure.
understand, because it's kind of geeky stuff, but it's fun to know because this is what's going on. So why does the Fed's excess reserves? So So in other words, if the federal funds rate is only a quarter point or near zero, the Federal Reserve Bank of New York, Fed, can actually pay the banks more than that. They can just pay them whatever they want. You said they pay them higher interest. Can they change it, or is that a Powell thing?
No, the Federal Reserve can certainly change it.
Okay.
And what they want to do is to say to the banks, we want to make it either easier or harder for you to loan money.
Okay.
Will we encourage you to loan money, or would we encourage you to keep reserves that you have on your account? So if we want to move the economy forward, we're going to make it more readily available. We're going to try to make it so that the banks have more of an incentive to try to loan more money out.
Right.
So by altering these rates, it's just another mechanism for the Fed to enter into the economy and have an impact, since it ran out of room by simply adjusting the normal interest rates.
Okay, but I'm having a hard time understanding why Wells Fargo putting some excess reserves in the Federal Reserve Bank of New York and getting some interest on it. How does that encourage Wells Fargo to loan money to Patrick?
Well, effectively, the banks are getting paid higher interest and yields on the money that they've deposited. So they now have additional capital from which they can derive and then use that money to make loans to the general public.
But aren't they sending the money to the New York Fed? I'm just not connecting. Help me out here.
Okay. So again, the Fed encourages banks to either keep large amounts of reserves or not.
By the interest rate.
And the result of it is if the banks are gaining a higher yield than they can get in the open market, they're going to keep more of that money within their own system, as opposed to going outside and letting that money filter through the economy. So again, the mechanism, it's a little complicated, but the end result is what we're hoping to achieve. And the goal is to try to encourage more lending, more spending, and to get this economy moving when the simple functions of lowering or raising interest rates is not sufficient. This is part of the reason the Fed began to institute quantitative easing. You can ask the same question: how does that really benefit the economy? How does that move anything forward? What these things do is it takes off of the market the higher yielding interest rate environment, leaving only the low interest rate items left available. And by keeping only low interest rate assets available to the general public, you effectively are doing the same thing as if you've lowered interest rates for the whole broad economy. Because things are gauged based on starting points. We have, for example, we're familiar with the prime rate. So if you're going to take out a mortgage, you're going to pay something over the prime rate.
Right.
So as that prime rate adjusts, let's say the amount over prime remains the same. Let's say you would have to pay, just for argument's sake, 2 points over prime.
Mm-hmm.
Well, if prime keeps dropping, then effectively that 2 point over prime also is going down, and therefore it's cheaper to borrow that money. And again, this would hopefully move the economy forward. So all these mechanisms the Fed has used have been with the same goal. It's how do we move the economy forward when simply lowering interest rates wasn't enough? The problem I have with this is the Fed was not supposed to start coming up with game plans and gimmicks and crazy mechanisms to try to get an economy to move forward. That's not what they should be doing.
That's their job. Right?
If we're sustaining only because of the Fed's intervention in the economy, we're really relying very heavily on them to keep these processes going. Do you remember they called it a temper tantrum? It was a 2014.
The taper thing?
Taper tantrum.
Taper.
Sorry.
Yeah.
That's what I meant.
I remember.
The taper tantrum. So back in 2014, when the Fed had been aggressively doing its quantitative easing, which again is the purchases of assets in the Treasury world at the longest end yield curve. Those are the ones that pay the highest interest rate. So the 30-year and the 20-year, as opposed to the 1 and the 2 and the 5.
Right.
Why did they do that? Because those longer-term maturities paid higher yield. If the Fed was absorbing all of those higher yield investments, it only left available to everybody else the lower yield ones. which effectively had the same result as if they had lowered interest rates, because it set sort of a bar. If you can't get more than 3% return on your money, you don't want to pay that much to borrow money. So the Fed intervened by using quantitative easing, try to drive down available costs to borrow money. And the problem is the Fed has gotten so extensive in these asset purchases. In 2014, they started to try to slow down the asset purchases.
Buying the long term, the 30-year higher interest, right? They started to slow that down.
Yes.
They call that tapering.
And this was following 2008, where they were forced to make massive acquisitions of debt in order to get us out of the massive economic disaster in 2008.
Mm-hmm.
And they then had a few $1 trillion on their balance sheet, and they were trying to unwind it. So they began to slow down their asset purchases. Well, the result was, because it was such a big power play, and because the Fed was not merely a minor rudder adjustment, but at this point was more like the engine,
like you said.
They cut the engine so significantly, there was a knee-jerk, violent reaction. Stocks began to drop very quickly. And a lot of people became really concerned that the economy was going to stall because the Fed was now slowing down these asset purchases, and everybody became concerned that the economy couldn't sustain itself if the Fed didn't keep playing the game.
All right.
So this was when there was only about $4 trillion on the Fed's balance sheet. Imagine it now, when we've crossed that $8 trillion mark. We'll be at $9 trillion by next year because we're doing about $1.2 trillion a year in additional purchases. The Fed's still buying as of this moment, $120 billion a month in mortgage-backed securities and Treasury securities. $40 billion of it is strictly in mortgage-backed securities, which means not only is the Fed intervening in the broad market, but it's also intervening in the real estate market. And by virtue of that, it's intervening in the stock market. So we have markets that are artificially being manipulated by a massive movement of capital, by a massive central bank that is playing a very dangerous game, but it is supporting the entire economy.
Gotcha.
And it was not designed to handle that large job.
What he's talking about, folks, on the mortgage-backed securities is the banks like Wells Fargo will loan you money or make a mortgage. Then they'll put together maybe, 100, 200, 300 mortgages, slice and dice them, create a mortgage-backed security, a synthetic instrument, maybe even price it for more than what it's really worth, and the Fed will then buy that, and then that encourages the banks, right, Fred, to loan more, make more mortgages. And that's why, one of the reasons why real estate prices are they still going up around the country, Fred Dashevsky, still?
Absolutely.
Are they?
Yeah, and wow. I don't see much of a slowdown because this has created demand, right? So you can see the end result of what would happen if you keep driving these rates down and you make the money readily available. You do create an artificial demand. So the demand versus the supply begins to have an impact to where supplies begin to get smaller. Demand is still going up. The Fed is still pushing on this rope, so to speak, and they're still driving capital into that market, which means prices start to increase. So now you have prices going up on real estate, supplies going down, and the money available to make the mortgage loans becoming cheaper and cheaper as we move forward. And the Fed turning to those banks, Wells Fargo, and saying, look, if you write 100 mortgages, we'll buy them right from you so that you don't have to worry about that person who took that mortgage making the payments. We'll take the debt right off of your balance sheet. We'll pay you 100% for it right up front, and we'll stockpile those mortgage securities on our balance sheet and carry it forward until such time in the future as we can figure out a method to address it. And I don't even believe the Fed has a method, let alone
they don't really have a plan, right? The $8 trillion to get rid.
I don't think they have a plan.
And it's important to know, folks, when Fred says they buy this mortgage-backed security, what is it, $40 billion a month? They create these dollars. They don't have a stash of dollars. They create them on a computer, quantitative easing, right?
Exactly.
This is putting more money just into the system. So, you know, let me say something. Hold on. And this is also, Fred, can be likened to why it's driving inflation. For example, I got my haircut last week, and they raised the rent the lady who cuts my hair, $300 a month on this lady. Just boom, like that. So when real estate prices go up, rents also go up too, right?
Sure.
Yeah.
So did it cost you more to get your hair cut?
No, and I told her she needs to raise her prices.
Oh, she will.
And she will. And she said, I'm going to have to raise my prices to pay for the, and this is inflation, right? I'm going to have to raise my prices to pay my rent. I said, well, raise them. Go ahead and raise them $10.
You need to. Yeah, they have to keep pace because the
What are you
Fed,
gonna do?
Has to put money into the economy.
All right.
And the way it does that is by making these purchases of either assets from the Treasury Department. So, as we talked about earlier, the government deficit spends, and then it issues debt to cover the gap. So again, the government spends more than it's taking in. It issues debt in forms of Treasury bonds and notes. The Fed steps in, creates money out of thin air, writes a check to the Treasury Department, buys those debt instruments from the government, and this is how it puts money into the economy. That not being sufficient, the Fed also does the same thing with the mortgage-backed securities. So it literally creates money to buy these debt instruments from both the banks and from the U.S. government. So it's been pumping money into the economy for almost 2 years at such a large pace that the increase in the money supply in the past year has been about 27%.
27% in 2 years. Whatever they had 2 years ago.
Not even 2 years.
Oh, is a 20% increase. But Fred, answer me this.
27%.
Riddle me this one, Batman. If there's a tremendous amount of jobs, right? People trying to find people to work for them, right? Huge. And so if the Fed wasn't doing all of this quantitative easing and all this money, $120 billion a month, wouldn't things be okay? I mean, why are they doing it? It's like aren't they causing inflation on purpose? They got to know what they're doing.
Absolutely.
Do they?
Well, here's the problem. It's a dual-edged sword. So they recognize all of this is clearly inflationary.
Right.
And we're beginning to see the impact of it because it's been about 2 years now that they've really been pushing hard on this, and it's building. So prices start going up, which again, we've talked about this 100 times. Remember, price increases are not inflation, but the result.
Yes.
They're the result of inflation. So the inflation is any time we expand the amount of money in the economy faster than the economy itself is growing.
Yeah.
Because the economy can absorb additional capital being created. But if the economy is growing 5% and the money supply is growing 27%, that difference is all inflationary. And it will show up in a weaker dollar, which will force prices higher. It'll lend the end result to your hairstylist saying to you, Patrick, I'm sorry, everything in the world that I buy, from the scissors to whatever she uses, and my rent is all going up. I have to pass those costs along to the consumer.
All right.
Food prices are increasing. Labor costs are increasing. Steel prices are going up. Housing prices are going up. Lumber, everything that we actually buy in the real world is becoming more expensive. And the rationale is that even though the Fed understands that it is creating massive amounts of inflation, the other option was if they didn't do this, the economy couldn't have moved forward. And we would have stalled into an extremely heavy recession that may have eventually become a depressionary economy.
You think that's true, or did they just make this up? Do they know?
No, that's absolutely true.
You think it was true?
We were stalled
because of the whole COVID thing.
Where we were about, even before COVID.
Really? Wow.
Even before COVID, we had a fundamental problem. The economy was heading toward 3 quarters in a row of negative growth. And that is, by definition, a recession. That's unhealthy.
In other words, GDP, gross domestic product, was actually 3 negative quarters before COVID?
It was just about. We were almost at the 3rd full quarter of negative growth.
During Trump.
And then the Fed said...
When President Trump was still happening. Now, wait a minute.
Trump came
Let's stop a minute. Okay, but it doesn't make sense. Wasn't he creating, because of his taxes and the whole tariffs, wasn't there a whole bunch of more jobs and things really happening?
Ah, yes.
Wasn't there during his last, or did he just
did
he just tell us? What? How could there be negative growth?
So here's what happens. We have this coming into this negative growth environment. We're about to hit this recessionary level where we would have been about the 3rd quarter in a row where the economy had slowed and slowed and slowed. So
Right.
not only was it not moving forward, it was stalled and effectively starting to drift backward. Well, Trump instituted a massive tax cut.
Yes.
Massive tax cut.
Yes.
Now, a tax cut has the effect of stimulating the economy because the basic idea is that you are reducing the amount of taxes everybody has to pay. Therefore, instead of spending that money writing a check to the Department of the Treasury, the IRS, you would spend that money buying that new dishwasher and
Whatever.
washing machine
Yeah.
and refrigerator, buy yourself a new car. So now you combine these two things, a massive tax cut and the Fed simultaneously lowering interest rates. That's how we move the economy forward. But it was understood at the time that that is a kind of a temporary solution because a massive tax cut creates additional government debt.
Yes.
Because it meant the gap between what they were bringing in and what they were spending got wider.
Mm-hmm.
So we have a much larger fiscal deficit now as a result of the Trump tax cuts. As that has followed through, we're now at a point where, for the first time since World War II, the entire output of the United States economy altogether, the entire GDP, barely covers the deficit spending of the federal government. We haven't done that since World War II.
Okay, explain what you mean by that. So isn't our GDP like 17 or 20 trillion?
Yes.
Okay, and what did you just say about the GDP?
We are deficit spending as much as the entire GDP of the United States. We're actually blowing through as much money as the entire economy is putting out. It's a dangerous.
No, wait a minute.
environment.
Hold on. We're not deficit spending 17 trillion a year. I'm losing you there. What are you saying?
Well, we're deficit spending at a pace that is equal to the growth in the GDP. So, in other words, where normally the growth in the GDP would account for much more than what the government deficit spent, and there would be a positive net result, we are now at a point where, according to Office of Management and Budget, we're at about 102% GDP to debt ratio. That's an unhealthy environment.
GDP to debt
Greece
ratio.
got into this situation.
Wow. So are they about 2 trillion? Is it about 2 trillion a year now, Fed, with this fiscal year of deficit spending? Is that close?
That's interest. You're just talking about interest.
No. The budget for whatever fiscal year this is, they're about 2 trillion in the red, right?
Yes.
Okay.
And getting worse.
So
the federal debt has been increasing at a pace that has been so dramatic. I was looking at a couple of just statistics for you.
Sure.
So yes, even before the latest aid package was passed, the CBO projected the federal debt would equal 102% of the GDP in 2021. It's exceeded this level only once before in U.S. history, and that was in the middle of World War II.
Are you talking? I'm kind of again trying to help us understand. The federal debt is
federal debt.
It's 30 trillion, right? Bonded debt.
Yeah.
Okay. What is the 102? What is 102%?
In other words, more than the output of the entire economy is being spent on what the government is blowing through.
Every year?
So everything that we're growing in the economy, all of that combined, isn't enough to cover what the government is deficit spending. That's how far in the hole we're getting. We're raising the amount of debt at an increasing pace that, according to Jerome Powell, is unsustainable.
He said that?
Those are his words. He said you cannot maintain this level of debt. And at some point, it's going to have to be addressed.
Wow.
So, we're facing an interesting problem. We have an economy that was all but stalled that has now been pushed forward by intervention of a central bank that is taking much more of a position in the economy than it was ever intended to. And the end result is that through various mechanisms, as complicated as they may be, the net result is we're just printing the crap out of money in order to solve the economic crisis. We're just simply printing our way out of the problem through the various mechanisms the Fed has. It's playing cards. It is using everything at its means and making up new ways
Ways
of
to,
adding money into the economy.
like the reverse repos we'll ask about. Here's a quick email before we're going to do a little break and talk about your company. This is from Mike. So is it fair to say we're in a housing bubble? So if I'm going to sell my house, should I do it now? Thanks for the show. Good question. So it is a bubble if the mortgage-backed securities are part of the deal, right? It's got to be
Absolutely.
bubble land.
So the question becomes, what is creating the current market value for your property? Is it a real market demand from a broad number of people that are moving money and buying real estate?
Mm-hmm.
I don't believe that's the case. I think there's two things happening simultaneously. The first is, again, as we've talked, the Fed has intervened. It's made interest rates ridiculously cheap, and that kind of creates some speculative buying as well. In other words, you're an investor, you're sitting on a pile of cash, you're trying to figure out what to do with it. Normally, in an uncertain economic environment, you don't know where to go. You're uncertain that the stock market may hold its current value. Maybe you're afraid it could drop 30% from here. You might just simply park that money in a treasury security or a CD and let it sit there and earn interest for you until such time as you can come up with a logical reason to spend it in some place that seems smart to you about where to park the money.
Uh-huh.
But if the interest payments on standard debt instruments don't provide any real yield, we have, and again, this is going to get a little complicated.
All right.
We have a negative yielding environment, right? So effectively, you put money in a CD, you are earning, let's say, 1%. You are actually losing money.
Yes, because of inflation.
How's that possible?
Inflation.
They're paying you at 1%.
Right.
But inflation is chewing up 3% or 4% of the money in the same time frame. So technically, you will have more dollars in the account than you started with. You get the bank statement, it'll tell you you've got more money, but the buying power of what you have with the additional money is less than what you started with. That's a negative yielding environment.
Negative yield.
Because of that, it forces people to speculate. So if I'm not going to park my money in a CD because it's a losing proposition, well, maybe I'll buy a piece of real estate. Because if prices are going up, they may go up
Real estate will
faster
go up, right?
than what it costs me to borrow the money.
Yeah.
So here you have cheap interest rates, making it really, really inexpensive to borrow the money for the mortgage. You have prices that are going up because the Fed is going to the bank saying, I'll take that mortgage and 100 more.
Whatever you got.
Keep giving them to me.
Whatever you
I
got.
want to buy $40 billion a month. Here's an open checkbook. Just keep selling mortgages because we're buying. No end in sight. We'll keep buying for as long as you can keep producing. So what's going to happen to the prices of the real estate? They're going to keep going up. But is it real? And I think it is very bubblicious. I think we're really pushing the envelope. So the short answer is, if you have someplace to go when you sell the property, this is a seller's market.
Go.
Unquestionably.
Go.
I've talked to half a dozen people in the past month, all of whom in various places in the country listed a piece of property and in most cases sold it within less than a week. In some cases, it was the same day.
We hear those stories all the time around here, Fred, with people moving in from California, of course, Texas. Yeah, it's hot, boy. Mm.
And that's not always the case, right? That wasn't the case in Texas 10 years ago.
No.
Normally you have much more of a sort of a balanced market. There are some undervalued areas, and yeah, sure, there'll be some properties that look attractive, but as a general rule of thumb, you can get what you want for your property now.
Would there be any reason, Fred, that in a place like Texas or Florida that's hot or other places where it could just keep going up and sustain these excess prices going up for 2, 3, 4, 5 years? Would there be any reason that would take place? What would have to transpire? The Fed keeps doing what they're going to do, but then inflation would be maybe 20%. They're not going to do that, are they? Won't they have to stop sometime?
Yes, they are. No, I don't think so.
You don't think so?
I think they face a fundamental problem. I think that taper tantrum was an exact
I see.
Kind of a view of what would happen if the Fed tried to slow down what it's doing. Again, my big point here is how large the Fed has become a force in the economy. Sure. It's no longer something where they can just simply say, okay, we're one party amongst a larger group, and we're going to stop playing, but everybody else can continue and everything will be fine. It's not like that. The Fed is the key now to the entire economy. So if, like you suggested, would the prices keep going up? All that would have to happen for that to be the case is for the current conditions to continue. In other words, the Fed would continue to buy mortgages, continue to artificially manipulate rates through whatever means are necessary, whether that is excessive bank reserves or simply lowering rates or
Right.
buying quantitative easing, things of that nature. If these conditions remain the same, prices will continue to escalate because we can't create enough real estate fast enough for this additional demand, not only coming from people that want to buy a home, but again, as we alluded to, a lot of it is speculative money because some people have nowhere else to go with their capital. There's no yield out there.
Because even
else.
10 years, I saw this morning, 10-year treasuries are what, 1.3%, right?
So, would you be willing to lock up $100,000 at 1.3% when you knew you had to hold it for 10 years?
No way, man. I'd be
fruition?
calling you get $100,000 worth of coins, what I'd be doing. But that's just
Sure.
me.
Now look at gold and silver coins. So here we have silver. I went back and looked at some of the money supply numbers. Back in 1990, there was maybe, I don't know, 3 trillion in the money supply.
No kidding.
1990.
3
Doesn't seem
trillion.
that long ago.
3
but I know it's 30
trillion.
years, but
Jeez.
3 trillion, right? And silver was about $4.80 an ounce.
Right.
So today we have, let's call it what, 30 trillion in the money supply?
35, 40
And
maybe.
we have
Who knows?
at $26 an ounce.
So what does that tell you about silver?
It kind of gives you an indication that there is a method for people to store wealth. It's just not paper. It can't be paper because we're going to continue to print money as far as we can figure because I can't see how the Fed can unwind its current policies quickly. It'll be too much of a hard, jolt. So that means that whatever they would have to do, it'd have to be done incrementally and slowly. And that's going to take time.
I see.
And if you think about it this way, we're still carrying debt from 2008. We're still carrying debt from 2008. The Fed has not been able to unwind. We've now more than doubled what's on the Fed balance sheet since then. How are we supposed to unwind $10 trillion worth of nonsense on the Federal Reserve's balance sheet in any kind of, reasonable fashion without making a real jolt
into
the
the
economic
So you're
environment?
talking
I
about,
don't
Fred, the
even
money
believe
that
the
was
Fed has a policy.
you're talking about the money that was spent for Bear Stearns and all the mortgage-backed securities and all the stuff that they bought during the Lehman thing, right? They were just buying that's what all that stuff
That
is
was
still
just the beginning.
Yeah, that was
remember
just the
that was
beginning.
roughly $1 trillion, right?
Yeah.
The 900 billion and change. So that began, the big purchase.
Oh, you mean the
of
TARP,
Fed.
the TARP thing. That was just the start of it. And then they did, whoa, kept
Right.
going. So
Now,
you're,
if TARP had been an isolated incident,
Yeah.
if it had ended there, and the Fed had not continued to add to the balance sheet, we still would have $4.5 to $5 trillion on the Fed's balance sheet today that has not yet been dealt with
yes, sir.
from 2008. So I ask the question now in 2021, how long from now are we still going to be discussing what they had to do to get us out of the COVID pandemic? How long down the line? How many years will it be? I'm estimating at least a decade.
Well, so
I assure you
your
that
argument is
you and I
interesting, though,
talking
for people to
20,
understand that even if they get religion and they know they got to stop it and they want to raise interest rates to slow, inflation down, you're saying that they're going to have to it's going to take them 10 years to do that. You just can't go raise interest rates from 0.25 to whatever, 3 or something. Then the whole
Right.
thing just falls apart, right?
You have to do it slowly, otherwise, again, it's like hitting the brakes. You've got to sort of tap them. You can't just slam on the brakes and not expect everything to move, to jerk forward and have knee-jerk reactions and people blowing through the windshield. You can't do it. You have to do it slowly. You
Yeah.
have to do it carefully.
Wow, it's
Because the Fed doesn't quite know what the results of their monetary policies are for between 8 months and a year after they'd institute them. They really don't know what the effect's going to be. They have to do it ahead of time, speculating, and then watch for the results, which has been very interesting if you listen to Jerome Powell, because for the last couple months, he's gone through this, I don't know, I think he's in a state of denial, but he's gone through this phase of saying, there's no inflation, there's no inflation, there's no inflation. Well, statistics came out to sort of disprove that. I mean, everything we were talking about,
Sure.
the cost of your hairstyle was going up and rent going
Rent
up,
going
the
up.
cost of everything
Food,
going up. Well,
everything.
it became so clear that there obviously was inflation in the economy. He no longer could say there's no inflation. So he moved from there's no inflation to, well, we're not worried about this inflation because we think it's just transitory. We
Right.
don't think it's going to
Well,
last.
I'm not gonna lie.
Well, that apparently didn't hold up very well either. So now it's moved from, okay, not as the now first there's no inflation, then it's only transitory. Then it became, okay, maybe there's inflation and maybe it all won't be transitory, but we're not worried about it because we can always raise interest rates if we have
We can always do.
to address it. We know how to do that. So nothing to see here, folks. Keep on moving and don't pay any attention to the man behind the curtain. We're just going to keep printing money, and you guys go ahead with your life, and don't worry about any of this. But for those people that are aware,
They know. They
they
know.
should recognize there's going to be a result of all this intervention, and it is a significantly weaker U.S. dollar.
Which would be higher gold and silver, right?
Higher gold and silver prices, higher almost everything tangible, highly inflationary. And the problem is it erodes savings. And unfortunately, this impacts the average and the lower income people much, much more.
Yeah.
It's those people that get really hurt when the money that you've worked hard and put away and stashed away is being deteriorated faster than you can make it. That's a real big problem for an average person.
Well, if you'd like to dip your toe in the water for gold and silver, which pretty good shot's going to go up, according to what we're talking about the last 45 minutes. Fred, tell them a little bit about your company. I'm going to give them the 800 number and everything right here. And it's U.S. Coin Capital, 800-878-2646. So why do you like gold and silver coins rather than just buying a block of gold or a gold bar or something? Oh, I don't know why this thing is doing it. Hold on a second. Your microphone's now. So weird. Okay, go ahead. Okay, I got you. Yeah.
All right, we're back.
Yeah.
After 37 years, a couple things have come to, become clear to me. One of those is that we're not going to be able to alter the fundamental problem. We're not going to be able to stop the government from deficit spending. A lot of people believed it was political, that if you put the Democrats in power, they wouldn't do it. If you put the Republicans in power, they wouldn't do it. Or one or two of these, or the other of the political parties would have the strength or the intelligence to come up with a plan to prevent this monstrous deficit spending problem from continuing. Historically, that has not been the case. It is not political because it doesn't matter what political party is in power. None of them can avoid the overall reality. The government is already $31 trillion in debt. The interest payments alone are choking the government, and it's continuing to add to its debt as we move forward. With that, I've always believed that there had to be a fundamentally better way for people to protect their wealth. And I believe any form of physical gold or silver is certainly far better than a paper note. But amongst the various forms of gold and silver, the United States coins are unique in a couple of importantly in my mind is the fact that they are fixed in supply. So we stopped minting gold coins in the United States when Roosevelt was president. This was 1933. We have not minted a gold coin for currency in the U.S. since 1933. The remaining supplies of these are what people should be acquiring. And in silver coins, we had to stop production of dimes, quarters, and half dollars of silver in 1964 because we simply couldn't afford to make a silver quarter for 25 cents worth of silver. If it cost 30 cents worth of silver to make a quarter, well, people would melt the coin for the metal, make the extra 5 cents, and the coin would never circulate. So that was self-defeating. So they simply pulled all of the silver out of the U.S. change in 1964. So a 1965 dime or quarter has actually zero silver content. But 1964 and earlier, they're made of 90% silver. And that's why I believe those are what people should acquire, because they are fixed in supply, as opposed to a bar of gold or silver that can reproduce every day as long as there's still more silver to make into bars. And every one of them minted, 100 years ago, 10 years ago, and 10 years from now is exactly the same as ones being made today. The other issue with the bullion, if you will, and those are the bars and the rounds and things that are not legal currency, is the government has now regulated that part of the world. So they own and control the regulatory issues surrounding the trading and buying and selling of bullion products. What that means for you, for example, if you were to sell me $10,000 worth or $2,000 worth or $100,000 worth of bullion in any form, required by federal law to take your social security number, to file what's called the 1099-B, mail that to Internal Revenue with your personal information and what you've sold it, which looks like income to the IRS, unless you can show and prove you have a lower cost basis than the current price. None of those regulations apply to the American gold and silver coins. So we have a free market there that I am not required to take personal information from my customers, and I'm not regulated as a dealer by working within that world. So between these types of assets, again, I'm sort of a fan of anything physical over paper, but between the various paper products, there are definitely distinct advantages to the coins. So what our company specializes in is in these pre-1964 silver dimes, quarters, and halves, pre-33 gold coins, and we physically provide them to our customers. You take physical possession, you own them outright, and we will help educate even the complete novice in how to do this properly, why to do it, and then provide the physical product directly to you.
Pretty fun. And you send it, you send them registered mail? Is how you do it? Registered mail?
We've actually shifted now to FedEx, believe it or not.
I'll be darned. Yeah.
Not that I'm promoting FedEx per se.
But it's easier.
However, the United States Postal Service, unfortunately, has become a bit, I will politely say, erratic.
Yeah.
You know, they're slow.
Yeah.
They're irregular in their delivery. You know, I can ship two things to you. One will get to you in 3 days, and one will get to you in 3 weeks, and they can never tell me why. So we have gone to FedEx. So in other words, if you make a purchase from us, it'll take maybe 7 to 10 days at most for us to process, package, get everything shipped. It'll be out the door, and then by FedEx, 2 days later, it's in your hands.
Boom. So is that all insured then, or do you have to take out extra insurance? Is how you do it?
Oh yeah, we cover that on our end. So it's not on the customer's side. That's all on us. So we make sure that you get your stuff safely.
Pretty cool. Wow. So on the pre-64 dimes and quarters and halves and even silver dollars, people can kind of buy whatever they want. Just doesn't matter.
Yeah.
Yep.
You can buy $1,000 worth or $1 million worth. We've sold both and regularly, and it's becoming an interesting prospect. That there were a couple of times this year where demand so far outstripped the availability that every dealer in this industry was short silver quarters, dimes, and halves, which to me is a little strange because in the course of my career, I've handled a lot of really rare coins. And I mean, they're rare. They're coins that you can find once in a lifetime. The coins like the silver dimes and quarters and halves, I mean, that's, they even refer to the lowest quality of that as junk silver. That's how readily available it's supposed to be. It's supposed to be the most ubiquitous product in the industry. Yet even that has become problematic from time to time this year. That's a pretty interesting indicator that demand is starting to outstrip this remaining available supply. So I do encourage people to try to begin to stockpile physical gold and silver coins. If you haven't done it before, this is a great time to begin, because with interest rates and inflation right now, even though it's artificial, they are really low. And that's your buying opportunity. Just like we were talking about how this has created a seller's market for real estate, this is a buyer's market for gold and silver coins. Because
it's probably not, you never know, but it's probably not going to, gold and silver is probably not going to dip way below what it is now long term, right? It just, the fundamentals.
It's very unlikely.
Yeah, it's very unlikely, right?
Amount of money being printed, it just seems unrealistic to predict that. I would expect, however, occasional volatility.
Sure.
It's part of the natural growth in the market. We've been talking since the times when, silver was $8 and $10 an ounce, and it kept bouncing back and forth, and it'd get a little over $10, and then one day it would dip, and Next thing you know, we're looking at $8.80 again. And well, those days are gone. Then the next range seemed to be between $12 and $15, and we were in that range for a while. So it might hit the higher end and pull back. Now we're between roughly $25 to $30 for silver.
Mm-hmm.
And I think that's what's going to keep happening. It'll keep climbing with the occasional pullback to the lower end of its current trading range. And that should be expected because there will be some times where when you're coming out of a pandemic and you have an economy that was effectively growing at, let's call it zero, if it suddenly starts growing at 4 or 5%, well, that's a huge leap forward. So that's very positive economic news. And that should cause a movement of money away from the inflationary investments to the more traditional things. People will buy more bonds and stocks. And then the reality will catch up and people will look at that again and say, well, that wasn't such a smart move. And remember, you also have a lot of day traders now. And these are guys that have massive amounts of money that are thinking about 8 hours from now. They're not considering money 5 years from now, 10 years from now. They're thinking about later today, tomorrow. So if they want to position themselves to, gain or lose on any given moment, they will parse every word coming out of Jerome Powell's mouth to say, what was he anticipating he's going to do next? Or, what is his forward outlook? Forget about what he's saying about today. What's he thinking about 3 months from now? And if we can get our head wrapped around that, maybe we can get ahead of the curve and anticipate what would happen, and therefore we can move our capital into those areas that would benefit from these short-term movements. This is why we get volatility in the gold and silver, plus, of course, all these options and futures contracts
all those things
in the bullion world that are so heavily leveraged. When you leverage an economy, you leverage a market or a commodity, you can gain heavily from the increase or decrease if you're on the right side of that, but that also causes volatility. So that is a natural part.
And then you think, Fred, we'll ever see the day when the big boys will not be able to keep the price down or like they've been doing, and that's been ongoing since I've been talking to you guys for 20 years, right? I mean, that's been ongoing.
Sure.
All right.
Well, gold and silver are kind of a signal, if you will. You mentioned the dollar index is under 93 now.
Yeah.
It had dipped a couple of weeks ago. It was down to like 89.
Was it?
And sure enough, gold was about 1,900 an ounce that week, and silver was about $28. So the dollar strengthened on some good economic news, and the dollar index goes up from 89 to 91 and 92, and gold and silver drift down a little bit. So we'll continue to see this. But you can kind of watch that dollar index. Pretty good indicator. You can almost not look at gold and silver.
Just look at that.
And guess its price just based on the dollar index.
Mm-hmm. Yeah. Fred Dashevsky is with us. He comes on the first Monday of the month. Explain just,
Wednesday.
Wednesday of the month. I want to get back, explain a little bit. I keep reading about these reverse repos. It's a little geeky, but I'd like to understand why this is significant in the amount of money being printed. What is a reverse repo thing?
Are you talking about a reverse mortgage?
Reverse repo from the Fed and the banks. Over repo. No?
So I'm not clear on what you're referring to.
Okay. They call them reverse repos, where isn't it some kind of overnight thing with the bank where they buy something and then they lend them money for 24 hours and then it goes back? Maybe it's not even...
Okay.
You know what I mean?
Gotcha. Overnight window purchases.
Yeah.
So
What does that mean?
Here's what happens. Well, the Federal Reserve requires banks to maintain reserves.
Right.
And they can alter those reserve requirements from time to time. Now, let's say it's coming to the end of a quarter, and the bank has loaned a little bit more money than it's supposed to have in reserve. What it can do is one bank can go to another and borrow money overnight, or it can go to the Fed and borrow money at a discounted rate in order to simply build its balance sheet to support the statistics the Fed is requiring.
Oh.
So if the Fed says you're supposed to have X dollars on your balance sheet available to loan, but you've actually exceeded that, in order to make sure that you qualify as the end of the quarter comes out, you can make a short-term purchase of money. You build up your reserves to the level you're supposed to have. You basically borrow the money just for that point until the Fed says, okay, we've looked at your account, you're good to go. You can then turn that money back over. And whoever has loaned it to you will make a minimal amount of interest for the short-term loan. It's an interesting gimmick. Again, it's a way of the Fed kind of providing the liquidity the banks need to make sure that they can maintain levels. And effectively, this theoretically comes through Congress, where Congress is saying, look, we don't want the banks to be exposed to potential problems like we had in 2008. And the problem, of course, then was liquidity. Lehman didn't have the liquidity it needed. So what they've done since 2008 through acts like Dodd-Frank is they've required banks to maintain a certain quantity of money in reserve at all times.
Mm-hmm.
And that's checked at the end of every quarter. So up through that moment before the quarter ends, the bank can pretty much do whatever it wants. But they know that that moment at the end of the quarter, the Fed's going to peek at their account. And it's going to say, where are you? Are you at that level we required you to be? And if they're not there, the bank will make a short-term acquisition of money by borrowing it overnight from either one of the other banks who might have excess money, or if it can't get it from another bank, it can actually just borrow it from the overnight discount window from the Fed. So it shores up its account temporarily, makes good on its obligation to sustain its excess level requirements, and then the next day it goes back to business as usual.
Does Fred think, this is from Kaya, does Fred think that the Basel III going into effect has any long-term effect on the price of gold?
I'm going to say no. I think there's too much going on with the price of gold for even something, like an agreement like Basel to really have the impact. Again, gold has always been a worldwide market. So it's the reason why the more you know, the harder it is. It's kind of one of those things. If I asked you to predict where gold would be tomorrow, you'd have to look at a huge number of variables. And agreements that are made, they're one part of a bigger picture. So as a short answer, I'm going to say I don't think by itself it's going to have any kind of impact on the price of gold. I think the real price of gold, since we denominated in U.S. dollars, right? Gold as a commodity effectively for most of the world is denominated in U.S. dollars. It's like a mirror. So what are we looking at? We're looking at a reflection when we're looking at the price of gold. What is it reflecting? How strong is the U.S. dollar? That's why when that dollar index creeps up, the price of gold tends to go down. Because again, we're reflecting the value of gold based upon the relative strength of the U.S. dollar.
Russia, I read this morning, $200 billion sovereign wealth fund. They finally got rid of all of their dollars. They're all in yuan and all kinds of euros and other stuff. They're just out of dollars. But why would the world continue to want dollars if they're creating so many of these pumpkins?
Well, let's look at it this way. What is your option if you don't? What are you going to do instead? Are you going to buy yen? Are you going to buy yuan? Are you going to buy euros?
Rubles?
What do you think is going to fare better than the U.S. dollar? Now, keeping in mind, we just celebrated America's independence. We remember the breaking free of the United States from Great Britain and everything that came with that, and the battle we've been fighting over the control of money going back to the 1790s. So we look at things like resolutions of war and what we've done to support the U.S. dollar over the decades. One of those things was Bretton Woods. Anniversary of that was just about a week ago. So the end of World War II, we effectively strong-armed everybody in our coalition and said, from here forward, we're going to create the International Monetary Fund, the World Bank, and we're going to make the U.S. dollar the world's reserve currency.
Yes, we are.
So by having done that, we force-fed the dollar to everybody and forced all of central banks around the world to stockpile some U.S. dollars because they need them to conduct commerce. So, the question becomes, if you didn't want to hold U.S. dollars because you look at our environment and say, well, hell, this government's $31 trillion in debt.
Guys are bonkers, man.
It's adding $1.2 trillion a year. It's growing so fast that the entire economy's output could barely sustain the deficit spending of its current government. There's no end in sight. Where else would you go? If you're going to look for an alternative currency, the problem is it's not like there's a stable central bank anywhere else that you could look at. It's not like the United States through the Federal Reserve, is the only country whose central bank has intervened in its economy. Every central bank in the world has been using a stimulus program, one way or the other, to drive its economy.
They're all doing the same thing.
Doing the same
Same thing, yeah.
So it's just a question of, it's like a horse race. It's like that old machine used to crank up, and the horses would run around in a circle, and one would get ahead of itself for a little bit, and another one would get ahead of itself for a few minutes. You could play that game and bounce back and forth between the currencies, but in the end, what's more stable than the U.S. dollar? As bad as we may be, as we like to say, we are the cleanest dirty shirt in the laundry.
Yeah. I wonder where all the money that's dumped into some of the cryptos, just mainly Bitcoin, came from. Where would that be if we didn't have a crypto? I was thinking about that the other day. Where would that money be if we didn't have?
Well, it would have gone into any other type of investment vehicle. Again, what's created interest in crypto has been the same fundamental problem that's driven the real estate market up. It is a lack of available return on standard investments. It forces people to look for alternatives.
They get risky,
even
and they'll do it.
Speculative.
It's going up, baby. I'm going to buy some, right?
That's it. They just reported there's been about $82 million worth of scams in crypto in just the last 8 months or so. And now they're talking about much more regulation coming down the pike. The SEC is trying to figure out how it would regulate cryptos. The Federal Reserve is trying to figure out whether it has authority to regulate. But I guarantee you, I've said this from the very beginning. I kind of stood alone at this at the very beginning, but I was convinced that, anything that became a tool that people tried to use as an alternative to the dollar would be either squashed or regulated. And since they are not going to squash the crypto, they're going to regulate them. And they're going to regulate them.
What do you think they're going to do?
Same auspices.
What do you think they're going to try to do, Fred?
First thing I think they're going to do, I think they're going to institute a $10,000 transaction limit.
Really?
So do you remember when the war on cash started?
Yeah.
Right? When they first started the war on cash, how were they going to curtail your ability to spend large amounts of money that they couldn't see? They physically couldn't prevent you from having the cash. They couldn't prevent you from meeting me on a corner somewhere and handing me a briefcase, and I hand you something, and we both go our separate ways.
Right.
So what they did is they regulated the transactions by a dollar amount and said, look, if I'm going to violate the law, that's fine, but legally, if you give me $10,001, I have to file a 1099 and send it to Internal Revenue. If you try to take $10,000 in cash out of your bank, try to do that. First of all, the looks that you'll get from your bank teller, the amount of forms they're going
Plus, you'd have to give them notice too. They don't have 10,000 sitting around, right?
And they may not even have. That's the other part. So, presuming they have the cash, but try to pull $50,000 in cash out of your checking.
Not going to happen.
Cash.
Yeah, not going to happen.
They'll write you a check, but what they did is they regulated by virtue of saying large amounts of transactions, whether or not what you're doing is legal or not, we can't control. We can't control where the money may have come from. So I think they'll apply this to the crypto. So let's say, for example, you want to do a Bitcoin transaction that exceeds $10,000 in value. That will become reportable. So this way, no matter how you got the money, what you paid for your Bitcoin, how you're spending it, who you're giving it to, it's going to become a reportable asset. But I do believe it's going to go much further than that. I think the SEC...
Yeah, but Fred, to your point too, legally, and I just saw it on my tax return this year, they ask you if you bought and sold any cryptos right there on the form.
Yeah, where'd that come from?
Yeah,
right?
yeah. So,
That's
and
great.
if you lie, you can go to jail, dude. I mean, that's,
Right.
So you don't want to mess with that stuff. It's already reportable.
No, and
it's already reportable. They
is.
don't have to do anything else. If you buy Bitcoin at 30,000, sell 35, you got to pay 5,000 in tax, period. Otherwise, you're breaking the law. That's just the way it is.
And you have to report it. So
Oh, yeah, that's
there's
what I
the
mean.
problem,
You got to report
right?
it. And if you don't report it, you're
have to
filing a
report it
false
already.
return. And you go to jail. So don't do that.
Exactly.
Don't do that.
They will control a lot of this stuff through the advent of more and more regulation. And I think the regulatory issues will get stricter as we move forward.
Sure, no doubt.
The more money that goes into these cryptos, the more it becomes an issue that, SEC and the Federal Reserve will have to look into, just from a consumer standpoint of protection. they're going to deem it as a potential problem. Unfortunately, a lot of the volume transactions that occur in Bitcoin are still happening within the illegal world,
Sure.
paying off
Sure.
of threatening debts and things like that. So, we've had these hacking instances where they've demanded payment in crypto because they think it's untraceable. Well, the FBI kind of proved that wasn't true either. They did track down the pipeline guys, and they actually got back the money that they had gotten paid.
Yeah.
So if people think that these transactions really are completely private, I think they're deluding themselves.
No,
so
they're not. They're not fun.
my belief is they will become regulated. And the more regulations that you apply to a market, the more strictly, it becomes regulated, the less attractive it becomes.
Yeah. Fred, we got to run because I have another interview coming up, but it's always an honor here to have you. Thanks for coming on the show. Give a quick little plug here for your company. I'll put your slide up again, 800-878-2646, right?
Yep. U.S. Coin Capital, spelled like the building, CAPITOL.com.
Right.
Email us. Give us a call. We'll be happy to talk with people that are interested in accumulating some gold and silver coins for wealth protection. And I think this is a great time for people to do so. We've got a great qualified staff here to help you. Whoever answers the phone is able to walk you through the process. So feel free to give us a call.
And what's your email? If folks want to email you, how does that work?
Yeah, well, my direct one is simply fred@uscoincapital.com.
I like it. It's simple.
Our generic info@uscoincapital.com. But feel free to send it direct emails to me. That's perfectly fine.
And you'll answer folks' emails with questions? You have the time to do that?
Absolutely.
Absolutely, man. He's a good guy. Freddie, thanks a lot. Take care of yourself. You tell Don and Roger we said hi. And
absolutely.
And we're getting more rain just in case you need something. I got it on sale here. We have my tanks are full, brother. They're just jamming, They're just
I'm glad to hear it. You guys have had drought environments, right?
Oh man, we've not any longer. All right, kiddo, thanks a lot. We'll see you. Take care of yourself, all right?
You too, Patrick.
Bye, Fred. Bye-bye. Fred Dashevsky, U.S. Coin Capital.